When we think about making it in the market, we always focus on picking the winners. But what if I told you that's not the secret? The real key, the thing that separates the pros from everyone else, is mastering the art of the loss. It's all about having a playbook for when you're wrong. So let's dive in. All right, let's kick things off with a quick question, and it really gets to the heart of the matter. Imagine your account takes a 50% hit. It gets cut right in half. What percentage gain do you need just to get back to where you started? Now, your gut might say, well, 50%, right? But that's not quite how the math works.
The answer is 100%. You need to double your money. Just think about that. That single, stark, kind of brutal piece of math is exactly why understanding loss is the absolute key to winning. The climb back up is so much steeper than the fall.
Okay, so let's really dig into that math. Because once you truly get your head around the simple, totally unforgiving arithmetic of losing money, I promise you, you will never, ever look at risk the same way again. This right here is what we call negative compounding, and the numbers are just staggering. A 33% loss, which doesn't sound that bad, actually needs a 50% gain to get back to even. And like we just saw, a 50% loss needs a full 100% gain. It's a simple, painful truth. The deeper the hole you dig for yourself, the exponentially harder it is to climb back out. So what's the big takeaway here? It's that keeping your losses small is, well, it's everything. It's not just about playing defense. It's about preserving your firepower, your buying power, so you're ready to strike when those real opportunities show up. A trader without cash is like a store owner with empty shelves. It's game over. That's why so many pros draw a hard line in the sand, a max loss of 10% on any single idea. Look, understanding the math is one thing, but actually having the discipline to act on it, that's a whole other ballgame. And it requires this really deep mental shift. It's about adopting a pro's mindset, where you realize that being profitable is way more important than being right. This quote just says it all, doesn't it? For most of us, our ego, our self-image, gets all tangled up in whether our trades win or lose. We need to be right. A professional? They couldn't care less about being right. They only care about being profitable. And trust me, those are two very, very different goals. And this lays out the two paths so clearly. The amateur runs on hope. They start making excuses for a bad position, telling themselves, oh, it's not a real loss until I sell. A professional, on the other hand, is playing a completely different game. They have a system. They follow their rules, and they see small losses for what they are. Just a simple, unavoidable cost of doing business. So how do you actually start thinking and acting like a pro? Well, you build a toolkit, a set of absolute non-negotiable rules, and they're all designed for one single purpose, to protect your capital so you can live to fight another day. Okay, here are 4 of the big ones. First, you have to know your exit point before you even click the buy button. Second, the moment that price is hit, you're out. No waiting, no hoping. Third, and this is a big one, never, ever average down on a loser. That's just sending good money after bad. It's like trying to bail out a sinking ship with a leaky bucket. And finally, be so careful with leverage. It can be a huge boost, but it can also wipe you out in the blink of an eye. And here's a slightly more advanced idea, but it's what really separates the pros. Your stop loss shouldn't just be about how much money you can stomach losing. It should be at the exact price point that proves your original idea. Your whole reason for the trade was wrong. If that level means you'd lose too much money, the answer isn't to move your stop, it's to trade a smaller size. Hey, don't just take my word for it. Let's look at how some of the most legendary traders in history built their entire careers on a foundation of almost extreme, super rigid risk control. For them, it wasn't just a good idea, it was about survival. Take William O'Neill, the founder of Investors Business Daily. He had this simple, ruthless rule. Never, ever let a stock go more than 7 or 8% against you. Period. No exceptions. And if the market was weak, he'd tighten that up to just 3 or 4%. But the real secret was the speed. The second that line was crossed, boom, the position was gone. Or look at hedge fund legend Paul Tudor Jones. He takes a more dynamic approach. He's watching his total portfolio value like a hawk. If his whole account is down just 1 or 2% in a single day, he might just sell everything. But here's the really genius part. When he's in a slump and trading poorly, he cuts his position size way down. He trades his smallest when he's at his worst. That makes sure a bad streak never turns into a disaster.
And the list just goes on and on. Jesse Livermore, one of the pioneers, had his 10% rule. Larry Hite will only risk a max of 1% of his entire fund on any one idea. And Peter Brandt has this fascinating rule. If a trade is losing money by the close on Friday, he's out. He refuses to hold a loser over the weekend. What's the common thread here? Every single one of them has a hard, predetermined line in the sand.
Now, we absolutely have to make a big distinction here. Everything we've talked about so far, that's for active traders. If you're a long-term buy and hold investor, the playbook looks completely different. In fact, if you try to apply a trader's rules to a long-term portfolio, you can actually do some serious damage. For a long-term investor, the number one risk control tool is something called the margin of safety. Basically, you manage your risk on the way in. The whole game is figuring out what something is really worth and then buying it for way, way less. That discount is your buffer. It's your built-in cushion against bad luck or you just being flat out wrong.
So you can see, the toolkits are polar opposites. The trader uses tight stops and quick exits to manage risk over days. The long-term investor uses things like valuation, asset allocation, and systematic buying like dollar-cost averaging to manage risk over decades. It's a totally different sport.
And for that long-term investor, the biggest risk isn't a market crash. Nope, the biggest risk is their own behavior during that crash. The absolute cardinal sin is to panic and sell after a huge drop, because that's the one and only thing that turns a temporary, on-paper dip into a permanent, catastrophic loss of capital. Your job is to endure the storm, not try to dodge the raindrops.
So let's bring this all home. Whether you're a trader or an investor, it doesn't matter. You are going to have losses. They are an unavoidable, baked-in part of the game. Trying to have a perfect record is a fool's errand. So that can't be the goal.
The goal is simply to survive. It's to make absolutely sure that no single loss, or even a nasty string of them, can ever knock you out of the game for good. Real long-term success comes from discipline, from having a plan, and from having the guts to stick to that plan when things get scary. So I'll just leave you with this question. The next time you're looking at a position in the red and you feel that knot in your stomach, that mix of hope and fear, just ask yourself, who are you going to be in this moment? The hopeful amateur or the disciplined survivor? The choice, as always, is all yours. Thanks for tuning in.